You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
All right, everybody. That music means it is time once again for Options Playbook Radio. You know the program, breaking down all the fun offensive and defensive maneuvers that you can utilize in your own portfolio. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from this fine network. And if you're saying to yourself, wait a minute, that guy's not usually on this show, you are correct. So let me welcome on the guy who usually is, a.k.a. your regular host, a.k.a. Mr. Brian Overby, the senior options analyst over there at Ally Invest, a.k.a. the options guy himself. Mr. Brian, welcome back to your own program, sir.
Well, Mark, it's great to be here. And for the holidays, I think it's great that we're able to give a little gift to our listeners. So we're going to try to address as many questions as we possibly can. And we're going to do a couple of listener questions over the next couple of shows. So I'm very excited that we have the opportunity to huddle up. And I want to say happy holidays to everybody out there.
It's time to huddle up and answer questions about your favorite options plays. Submit your questions via twitter.com/options, facebook.com/theoptionsinsider, or questions at theoptionsinsider.com.
All right, Brian, like you said, a bit of a holiday gift here for the listeners. Going to do some back-to-back Huddle Paloozas for you because you guys are kind enough and generous enough to send in so many questions. We don't like to leave you guys hanging for long if we possibly can. So without further ado, Brian, let's get into it. See how many of your fans we could bring here on the show. First off, I have to say, Brian, you do have some of the most polite listeners and fans out there on the net. Usually on our shows, they send in questions. Hey, what about this? Hey, what about that? Your listeners actually, they're polite. They ask nicely if they could ask questions. It's a whole different breed, which I love. Like our first listener here, this is Coco Wang, says, hi Brian. I love your book and learn a lot from it. I also have some questions in the book. Can I ask you via emails? So I'll go out on a limb and say maybe English not her first language, but a great job nonetheless. Brian, this is what I mean by how polite your audience is. They even ask if they can ask questions. What do you think about that, sir?
Well, that's just good, clean fun. And yes, definitely, you can ask questions via email. And we say it at the end of every show. It's the quickest way, and I have a box set up just for the show, ideally, or anytime I speak publicly. It's called The Options Guy at invest.ally.com. Now, that's options with an S, OPTIONS, guy, the options guy at invest.ally.com. So, Coco, I'll be looking, please sign your name, Coco, and I will be looking for an email from Coco over the next couple of days inside the options guy email.
There you go. That's not just for Coco. That's for everyone. He says it at the end of every show. So consider that your permission. We love that you guys ask permission, that you guys are polite enough to do that. But that you guys have permission. A lot of you like to reach out to us for Brian, but you can hit him up directly, the options guy at invest.ally.com. That way you don't have to wait for shows. You can hit him up directly, and he can get back to you directly in between episodes of this fine program. All right. Next up, Eric Norstedt. He says, "Hi, guys. Great show." Well, thank you, Mr. Eric. He goes on to write, "So with most big funds creating skew by selling calls and buying puts, could traders not arbitrage the skew by buying calls and selling puts and having a short position in the underlying?" And he goes on to write, P.S. If Ally is hiring any junior options traders, please let me know. I do believe Mr. Eric is a college student, Brian. So let's start there. Ally, are you guys hiring any junior options traders, sir? And then what do you have to say about his skew question?
Well, overall, I mean, Ally is not a trade desk or a prop desk, so no, we're not necessarily looking out for option traders overall, but we're always looking for option clients if anybody wants to come on in and start trading through Ally. But right now, we don't actually have any position.
What about a junior options guy? Is there a position for that?
Well, not at this moment. You never know what could happen in the future, but not at this moment as we speak.
So, sorry, Eric, you can't be options guy junior, at least for the time being. All right. What do you think about his skew question here, sir?
Grab the Twitter handle, though, at this point.
Oh, yeah.
Right?
There you go. Options guy junior. Go grab that. That's a good starting point.
Yeah, why not? Okay, so with that said, then jump into creating skew. And I guess I'll just run with it, all right? Here, Eric, so if we're creating skew, you realize that the skew is there for a reason. And there's a lot of people that look at it, and that when they notice it, they think, well, gosh, this skew is here. There's got to be a way that we can capitalize on it and take advantage of it. And usually if something looks too good to be true, especially in this now and age in the options market, they're extremely efficient markets. And there's really no if there was a strategy out there to try to take advantage of it, it's already been attempted. And if it even did exist, it would only exist for seconds. So let's say there was a scenario where you could do some type of some type of conversion or a combination where you could take advantage of the skew. You would instantly, especially with this day and age, with how fast people can execute trades, it would instantly come back in line. It would only be there for seconds, less than seconds, milliseconds, if it did ever happen. So overall, the skew is there for a reason, and part of the biggest reason why is that, people, especially if you look in the indexes, why is there skew in the put side versus the call side? And I'll just call an index out, the most popular one, the S&P 500 index, and it's mainly because options really were invented to be hedged products. They were invented to be insurance products overall, and the SPX is probably the biggest insurance product that most hedge funds and other type of big institutional investors use to try to protect themselves against the downside of the market. So if you ever just look at the open interest, you look at the implied volatilities, there is skew, and by skew I mean the puts will trade at higher volatilities on the out-of-the-money side than on the calls on almost every expiration out there because so many people use it as a hedge. And as we all kind of know, we all kind of got that gut feeling, markets have a tendency to go down a lot faster than they go up. Now, we do get big moves to the upside, granted, but the comparison to the huge moves to the downside when the market really does crash, there's just no comparison between the two. So anything to add to that, Mark?
Yeah, it's funny. I thought this question sounded familiar. I think we did touch on it on another program because I hate to keep the listeners waiting until we can get our huddles going. But I wanted to make sure we got Eric on this program because he specifically asked if he could become part of the Ally team. So I wanted to make sure he got in on his favorite program here. But I did relate on another program a story. I'll touch on it briefly here. When I first transitioned out of the SPX into Intel on the floor of the SIBO, this was back in the go-go.com 90s. Everything was racing, to infinity and beyond, and every big big fund had to own all the big tech names, right? So back then it was Microsoft, it was Intel, it was a handful of others. And so every big fund was coming in and doing exactly what you're talking about here, Eric. They were overriding calls and buying puts. So we as market makers out there, we could see this. We were not idiots. So we would see every month whenever a new option was added to the list there, it would inevitably get to the point where we as the crowd would be extremely long calls, so we'd end up crushing the calls because all they're doing is selling calls to us, and we'd end up getting extremely short puts because all the market would do was buy puts from us all day. The flow was entirely one-sided. It was very challenging from that regard. So what we would try to do is exactly what you're talking about, Eric. We would try to get ahead of this and not quite front-run it, but just position ourselves to withstand the inevitable tractor beam of the paper flow that was coming our way. And so if you saw any, and let's say the customers are obviously dumping calls to us, so if we in turn saw bids in the book that was even remotely reasonable for calls, we would try to dump them ahead of time, just to get some short call positions on the book so we can then in turn afford to be able to buy more calls down the road and vice versa for the puts. And the problem with that was it was a very short-lived prospect. You couldn't really maintain it for very long because, like I mentioned, the inevitable amount of paper flow that was coming your way. So you're not the first to think of this. You're not the first to try to do this in the marketplace. This is several decades ago now, and I'm sure it happened before then as well. But it's just something that's, as Brian pointed out, and particularly now with these large indices all moving in lockstep and arbitrage happening in microseconds, it's not something you could really pull off very easily in the long run. But an interesting idea. It shows you're paying attention. Keep studying. And who knows, maybe if you grab that handle there on Twitter, maybe someday Brian will relent and make you the junior options guy there, Eric. All right, next up, we got a lot of good questions here, Brian. Next up, we got one from, I like this handle, Option Fighter. I don't know if he's fighting against options, if he's fighting for options, what he's fighting, but I like the handle nonetheless. Option Fighter says, hey, insiders. Well, hey, back at you, Mr. Fighter. He says, I have a question about time decay when the market is closed. I'll ask a simple form of it that you could state on the air. Then I'll elaborate with the details of what I'm asking. It might be too verbose to read on the air. So his simple question is this. If I were to say to you the phrase, if the market ain't open, time ain't decaying, would you say that is true, false, partially true, or a legitimate point of contention? I'll just add a couple of his clarifying details here as well. He says he's read a bunch of books and blogs and podcasts to try to find exactly how time decay works when the market is closed. He says it doesn't seem like there's a definitive answer to it. It mentions about taking out a day for the weekend, that kind of thing. He says it seems like a hacky solution. If time decay did in fact occur when the market is closed, it seems like that would create an arbitrage opportunity. If time decays over the weekends, for example, wouldn't everyone and their brother rush to short time decay by selling options Friday afternoon and then buying them back Monday? Wouldn't the same also be true when the market is closed overnight, so between Wednesday night and Thursday morning? Please advise. An interesting question. I have some thoughts on this, but I'll let you go first, Brian. What do you have to say here for Mr. Option Fighter? He with a good handle here, sir.
Yeah, Option Fighter. I like that. Definitely. So here's been my experience, and I don't have a great answer to this question. I mean, if you think of option pricing models and you look at how the models work, yeah, they assume that the market's open 24 hours and decay is a uniform platform all the way across. As a matter of fact, a lot of option models will just break down when you get closer to expiration or you get way out of the money. They just don't really work. The price of the option is what the price of the option is. So my feeling about it is that, yeah, at the end of the day, on a Friday, is when you really start seeing a lot of premium come out. And I'm going to specifically talk about the S&P 500 index. And so the models imply that there's going to be decay that happens every hour of every day. But in the real world, I don't think that's really the case. And you will get some instances where, as the market is getting to the close on that Friday, where you just premium seem to come sucking out of those option contracts. Now, in my personal trading, and I've traded a lot of S&P 500 index option contracts, I don't know how any option trader could not, just because it's the biggest index out there and one of the more liquid indexes. I always thought that if I put a trade on Wednesday, from Wednesday to Friday, that premium would always stay in those option contracts. And I'm specifically talking about at-the-money option contracts up until that Wednesday. And then, man, on Thursday and Friday, all that premium's got to come out, and it's got to get to zero, just because that's the law of the land, right? If it's at the money and it's not in the money, it's got to have zero time premium because all the time has to decay. So I think, from reading your question, I would say that there is some truth to it. Now, can you leverage it? Is there a way that, because if you see this happening, is there a way that you might be able to try to take advantage of it? I don't necessarily. I've never heard of anybody that came up with a solution to say, well, if you do this, you can take advantage of the fact that these option contracts have to decay at the end of the market. It's happening for a reason, and it goes all the way back to the question that we just answered, is that, volatility skew. These people see things, and they notice it, and there's got to be a way that we can take advantage of it. Well, if there is a way, somebody's already thought of it, and if it is an arbitrage for a minute, then a minute is a way long time. In this world, a second would be a long time, and there's just really no quick answer to that. But overall, I would agree that, especially in the big indexes, the $3,000 indexes like the S&P 500 index, just because of the price alone, you have a high-priced option contract. And I don't care about how many days to expiration or where volatility is at. It's a 3,000-point index. So because of that, the options are going to be trading at a premium, and that premium's got to go away. So enough said. Back to you, Mark.
Interesting. I might take a bit of a counterpoint to that, which is, I guess I'm an example guy here on the show today. But I'll give you another example here, Option Fighter, of what we used to do, obviously, as market makers, and that's kind of where all this decay is coming from, as how it's being expressed out there, is effectively you do your trading for the day, then you come back usually at the end of the day, and you would adjust your skews depending on how things were lining up in the marketplace. A lot of that happens on the fly now. You had to do it a little bit more staccato, shall we say, back then, usually in chunks throughout the day and once again at the end of the day. And then also what you would do in your models is you would roll the date forward, however many days it would be until the next trading session. If it was one day, you'd roll it to the next day. If it was over the weekend, you would roll it to the Monday. And obviously, what does the model do when you do that? It assumes a relatively steady rate of decay for those periods, and it prices those into your options. So as a result, once you roll the date forward, it takes your decay out. Your prices will inevitably be lower on some of these things. So in a way, what you're saying is kind of tangentially true, and that you're right, it does. There is no decay technically in the after hours occurring because the markets are closed. Can't possibly exist then. But what's in reality happening is that decay is being priced in ahead of time, effectively like it is occurring. It's not like decay just stops and then it opens again. It's being priced in ahead of time. So, which is why you're seeing those markets reflecting that at the end of the day. Now that stuff happens pretty much simultaneously. The models are sophisticated enough to know and keep updating with decay as it's going on throughout the day. So they don't have to wait till the end of the day and then roll the date. They're usually pricing that in a little bit earlier ahead of time. So they've gotten savvy to that point. As to your other question about arbitrage opportunities. Now, we did see for a while there people trying to do this. You're not the first to think of this, obviously. And so even back in the day, people would say, hey, there's going to be some decay over this weekend. I'm going to dump a bunch of options on Friday right at the bell and buy them back on Monday morning. What we've seen over the years as a result is come back a little bit now. But for a while there, I'd say like 4 or 5 years ago, so it's really prominent, is it actually leaned kind of the other way to the point where we were recommending on the network, first off, never do that. Don't be the person coming in on the bell and selling premium and thinking you're getting a deal of a free weekend, because for the reason I just mentioned, that decay is already out. That decay is already gone. It's already been priced into the model. So what you're doing is effectively giving away a free weekend to someone else because you're selling that premium on Monday's levels already, or whatever it is, the next day's levels, whatever you're looking at there. Don't be that person. Don't fall into that trap. In fact, what's happened is that's become such a prominent trade. At least it did. I said it's backed off a little bit now. It actually became a good trade to actually maybe think about buying some premium at the close on Fridays or going into long weekends, because it was so overdone. You were already buying things on Monday, if not Tuesday's levels, because the decay had just come in. And the market makers had already lowered it, and then the customers continued to crush it beyond the point where decay would rationally have moved those options. So it actually became a little bit of an interesting buying opportunity. And as what inevitably happens, as the arbitrage, you point out, came in, people started buying them, and we kind of have reached a pattern now where by the end of the day on Friday or before a long weekend, usually, I say usually, it's not always the case, usually things are pretty fairly priced from a decay perspective. Now, when the decay starts coming out, that could be a whole other show we could talk about for hours, where, when the market makers start taking it out. Like, for example, we're coming into the holidays here for Christmas now. when we're going to start seeing that decay and that volatility is coming out of the marketplace is an ongoing topic of discussion. Will it be, obviously, Christmas is on a Wednesday. We're seeing Christmas Eve on it. Last year, Christmas Eve was the nadir of the market. So didn't see a lot of vol coming out then. It was the opposite. But usually you'll start seeing that vol coming out even earlier, maybe even by the end of this week. So there's a lot of debate about when that decay should start coming out. But usually by the time that event arrives, whether it's a holiday or a long weekend, that decay is definitely priced in. So I guess short answer to your question is yes, the decay occurs then theoretically, but it actually is priced out while it's still the markets are open. I don't know, Brian, do you concur with that, or do you have another counterpoint to my counterpoint?
No, not at all. Obviously you've thought about it and actually traded it more than I ever have. See, I just see situations like that, and you just lay down until the urge goes away because somebody else has probably thought about it at this stage of the game. So I just try to stay away from situations like that, just overall, and not try to play that arbitrage because arbitrage is for the big boys.
Yeah, I like that. Lay down until the urge goes away. That's a good saying, I think, for a lot of our audience to follow along with. But yeah, he's not the first person to write into the network over our decade-plus run now of asking should he sell options effectively on Friday and buy them back on Monday. The short answer to that is no. But Brian, we got some good questions here, some pretty detailed ones. I like it. If they want to join the party, like Coco here, who asked at the top of the show, or maybe they want to check out what you guys are doing over there in Ally, where should they go? What should they do, sir?
Well, you can always email me, as I say at the end of every Options Playbook radio. You can email me at theoptionsguy@invest.ally.com. Mark, thanks for hosting this event, and I guess we're going to come back next week and answer some more questions. So happy holidays, everybody, and we will answer some questions in the new year in 2020. Thanks for coming, everyone.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.